Fantastic. So let's see what's going on in the world. Oh, awful. All right. So the Russell's down 1.5%. The Nasdaq's down 2.5%. We know what that means. The S&P is down 1.3%, and the Dow is down 0.7%. And we'll take a look at the bigger picture charts and see what they say. Hang on. Not bad, not bad. These. So on a daily basis, we're weakening. This week has gotten is not good. We're going down, down, down. I think these are daily. So what's today? Wednesday. So Wednesday, Tuesday, Monday. So not a good week. We're coming back to the lows for the last few weeks. All right. So who's at the low? So the Dow's at the low. The S&P is a little bit above. The Nasdaq is pretty much at the low, and the Russell is even lower. So we'll see what kind of support they have. The VIX is being very slow to come back up. But let's see where it was. When we were this low before, the VIX was up. Well, it's kind of catching up to where it was. I guess it's sort of in the same ballpark. Europe was down 2.5% on the Euro stocks and down 1.8% on the DAX. The Nikkei was down 1.67. So everybody's, and you know, you got to look to see in the grand scheme of things, how's everybody looking? And our index is, by comparison, not the Russell, because the Russell, don't forget, is the one that we were giving a lot of leeway to, but our indexes are actually still holding up better than Europe. Europe has gone through a horrific fall that we haven't done yet. So you got to be really careful about that, because Europe's had a much bigger correction than we have, and they're failing what I would say is probably their strong bounce lines. Now this is monthly, so you put on a monthly perspective, and we still have the drinking. Actually, this is more of a spitting cobra than a drinking camel. But I talked about that because it has to be still going up when it's a drinking camel. But it's the same concept. In other words, a drinking camel will have to bend its neck down to get down to the water, and the striking cobra pattern, which this is more like, is when they coil up just like this. In fact, that's exactly what they do. They rise, they coil up, and then they strike, but the act of striking starts sending it lower, right? Because that's the snakes, because there's a physics to the body of a snake, right? So when it goes forward, it loses altitude, because as it goes forward, unless it can levitate its tail, which it can't, right? So unless it can levitate its tail, as it extends its body, it has to go lower. That's physics. And that's, you know, really how you should be using a chart. It's and again, it doesn't apply directly the same, but it does, because there's only so much money that can be pumped into the market over any given period of time. You can say, oh, we had a lot of inflows this week. Oh, we had a lot of outflows this week. But when they talk about a lot of inflows and outflows, they're talking about $80 billion or something like that in a $100 trillion market. That's 1% would be a trillion, so 100 billion is 0.1%. So they're talking about 0.1% inflows being significant weeks in the market. Weeks in the market is 0.1% of money moving in or out of the market. So in a crazy, crazy withdrawal, you might have outflows of 200, 300 billion. You're not even going to get to 1%. You're not going to get $1 trillion moved out of the markets in a week. It's physically impossible. The machine, and we've seen that because in 2008, the machines broke. You couldn't, the brokerage is shut down. They couldn't handle the trading volume. You know, with all this bullshit about the cloud and the this and the that, and they could do this and that, they can't. The reality is they can't. Things crash. Things start to go wrong. Just like denial of service attacks on websites. You know, too many people trying to do the same thing on the same network crash the network. So when too many people get on Thinkorswim and try to sell IBM, it crashes the network. Yeah, there become problems. IBM stops responding. Then what happens? Then people start calling technical support, and technical support is very quickly overwhelmed because they're certainly not staffed up. It's not technical support isn't a cloud. So when you call Thinkorswim technical support, they have the same 200 people sitting there answering the phones that they do on any normal day. They don't know the market's going to crash. They can't hire and train 1,000 more people to handle the increasing volume. It's not economically feasible to run that much extra staff. You know, you have an annual event where something like that happens. You basically get screwed. They do the best they can. It was a huge problem in 2008 when the market was crashing, as people's brokerages kept going offline. And frankly, Thinkorswim was basically one of the best ones. But they still had a couple of times they were slow, even being slow. Sometimes you wouldn't get the data. Sometimes you wouldn't get the results. Sometimes you place a trade, you didn't know if it was filled or not. You didn't get back a response. So, you know, again, these are the reasons that we hedge, though, right? Because if you don't have a balance and you rely on like instantaneous ability to modify your trades, it's not realistic. That's not how the market actually works. It works like that in theory, but in practice, that's not what happens. So that's why this morning we were looking at our short-term portfolio. It popped up to 493. I think that's still the current 492. Lost $1,000 bucks. All right. So we're at 492,000. We're up about $50,000 from where we were a week ago. That's fine. You know, we got a little bit of a sell-off. We're up a little bit. That's all we expect. Is that right? What was it this morning? Wednesday. Yeah, 490. Oh, it's actually up this morning. Up from this morning. So it's 492 now. And that's fine. And then we look at the long-term portfolio, because I mean, it doesn't matter what the short-term does in a vacuum, but the long-term portfolio is there it goes. Ooh, nasty. Wow. 2.4. So if this is 2.4 and the short-term portfolio was, what was the number? 490, so almost 5. So 2.4 and, well, so today's 2.9. We're actually in the combined portfolios. I think we were just about at $3 million. So we're down about $100,000 in the two portfolios. And I'll tell you, that's because the long-term portfolio, it shows right there. It took $75,000 hit today. So we got hit really hard in the long-term portfolio, mostly because we have a lot of short puts. And that's, you know, if it keeps going down, that's going to be a problem. We have to cut these and stop the bleeding. On the whole, are we down? We're not really down. It's 2, 2.5, 8.5, 9, minus 7 is 2, 3, 2, minus 1.5, plus 1.5, minus 1.5 again, minus 15, minus 20, minus 21. Well, I'll call that minus 20 still, minus 19, minus 10, minus 2.5, minus 1.5, 0. That's pretty funny. All that to get to 0. Minus 5, minus, call that 4 more is 9, minus 11, minus 10, forget those two, minus, minus 85, minus 9 and 27. So we're minus 27,000 roughly, obviously. So we're minus 27,000 net on our short puts. And the number one thing we want to do if we think the market is really crashing out is kill the short puts, because we don't need the pressure, the extra margin requirement, the extra pressure. I'd rather take the loss, and we can always resell stuff later. And I'm not saying we're going to do that right now, but if we start thinking that we're going to go back into the other chart, and we'll talk about that next, but if we start thinking we're going to get back into correction territory minus 20%, why should we ride this out? It doesn't make any sense. You know, we can just, you know, we're going to have a record of what we sold, and we'll say, okay, we'll sell it again later. You know, let it go lower, and let's sell the more puts for higher prices. There's no harm in doing that. Now, we could be wrong. It could snap up and go higher, blah, 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 but it's not, none of these are an emergency. They're short puts. We sell them because we want to keep track of stuff. But in a big sell-off, this is where your biggest point of vulnerability is going to be, is all the short puts that we sell. So if we lose another, we're down 27,000. If we're down 50,000, pull the plug, and then we'll decide which ones we want to sell again. It's just the same as doing a roll, really. I mean, you're going to pull the plug on these, and if we want to get back into them, we'll get back into them. And again, none of these, it's not like I don't want to buy these. It's not like I don't want to own them. It's not like I've changed my mind. But, well, Wayfair, we might have changed our mind because of those. We never really wanted that one. That's the one that's killing us. That's left over from another trade where we did make money on the overall trade, but it's annoying to lose money on the short puts. Alibaba took a big hit. That's one for sure that took a big hit. Coin took a hit again. That was only a short put that we had. Yeah, that short put's down $13,000. And it's, you know, not that I don't have long-term faith in Coin, but it did take a hit. Gilead, I know. Oh, Moderna. I'm sure we have Moderna in here that took a hit. Yeah, there's Moderna. They took a huge hit. Anybody else glaring? No, not really. Okay. Anyway, so it's not the long positions we're worried about. Those we're going to roll and stick with for years to come. So that's not a big deal. But the problem is that what happens is even though we have 1.7 million, yeah, 1.7 million in cash. So we have 1.7 million in cash. We're not worried about it at all. And we have the short-term portfolio offsetting the losses. But there's no reason to be foolish. And it is foolish if the whole market's going to start going down. And now, you know, I think in the news today, where's today's? Oh, we didn't do today's post. Yeah. Oh, that was today's post we were just looking at. So, you know, it's like in my brain, I've got these check boxes for things that I've been reading. And come on. The wheels going around. Well, like I said, this one's already done. RECESS. Recession. 13 times today, the word recession has come up. Okay, so recession for Deutsche Bank. Is this the same article? So you got to be careful if it's the same article. Okay, so that's recession for Deutsche Bank. That's a lot of times. Okay, this one is a different article, I'm pretty sure. Yep. Oh no, this is back to Deutsche Bank though. So you got to be, came up a lot. The word came up a lot, but it's still Deutsche Bank. Deutsche Bank, UBS also said recession. Harker said recession, or he's trying to avert a recession. So, you know, UBS and Deutsche Bank said recession. Harker said recession. You don't want to hear that. You really don't want to hear your policymakers and major bankers talking about a U.S. recession. So, you know, with stocks, when you have a lot of short puts, you know, you could say, oh, they're 2024, they're long term, we don't mind buying this price. Sure, all true, but I would rather adjust the positions I have already committed to than start all new positions, drain out my cash, because you never know. We could end up with a major correction. We could end up with 40, 50, 60% correction. We don't know that's not going to happen. So I don't want to sit there and jeopardize all my cash by riding out the short puts. We'll take a $50,000, in a $2 million portfolio, $3 million, no, $2 million. $2 million portfolio, taking a $50,000 loss is really not a big deal. So take the loss, move on, and it's only a short-term loss because we're certainly going to resell those puts at better prices and take advantage of it. And the funny, and you know what, I should have pulled the plug on W a long time ago because we know we don't like them. And honestly, if I go and resell puts, I'm not going to be reselling W because I don't like them. I mean, we never liked them. This was a short play on W, and this is just the leftover puts. So that won't get resold. Apple, I mean, obviously, we'll probably sell more of those. Alaskan Airline, I like. There's nothing I don't like. Boeing, I like. This seems silly to me. I might not even want to sell that one. That's silly. But then we fall into that trap. Like, I like all of them. It's not like I don't like them, but it's like you don't want to risk the loss, the indiscriminate loss when things start selling off. Because, the baby goes out with the bathwater in these situations. Where's my futures? Here we are. Like here, look, I mean, this just happened. It's funny how you have to constantly talk about the same thing happening, but people forget. It's like, this just happened to us. The VIX went to freaking 80 in March of 2020, and the market collapsed and went from this is like 3250 to it went to 2250. It lost 33%. Oh, it did. That was the right number. So the market dropped 33% in the month of March of 2020, just a couple of years ago. That's a big drop. That's a pain. And in fact, that was when we had just restarted our portfolios. We restarted our portfolios in the fall of 2019. We were lucky because we still had mostly cash. We hadn't, run in and bought all these positions. So, but we still took big hits on the stuff that we had because things were just indiscriminately selling off. What did we do? We doubled down on things. We bought more because we were still early in our cycle. But had we been complacent, or had we not cashed out our prior set of portfolios, which were getting, really bloated, and frankly, these are more bloated now. Our portfolios are now more bloated than our previous set were. But I said, at the time, I said I wanted to ride them out longer term, but now they're getting kind of ridiculous. Something that might be good to cash them out. They're just too big. There's too much in there. And it kind of takes the fun out of it. I like starting from scratch with clean positions. It's more fun. People get upset because they're following the portfolios, and you cash them out, and they're like, "Oh, well, what do we do now?" And it's funny because, kind of like that's the point of this. You're supposed to be learning to do these trades, not to have to follow the portfolios. But, I understand both points of view. And I wanted to keep the portfolios running also because what I wanted to do is demonstrate what happens over the long haul, which is these things start becoming real money machines. I mean, these things start kicking into really high gear in the third and fourth years. Especially we started with $500,000 and we're already up to $2.5 million. So even a 20% increase is adding another $500,000 to this portfolio. I mean, that's a nice way to retire. You put in $500,000 and now you're making $500,000 a year. So that's a good way to live through your retirement if you have to. But more to the point, this is up 383%, but the butterfly portfolio, which is more for that kind of strategy, 658%. I mean, that's just ridiculous. But we've been able to take really good advantage of these dips and turn them into something on a regular basis. But the key and the key to this, so the key to writing it out though, is having these hedges in place, is having the short-term portfolio hedges. So how's Money Talk doing? Oh, Steve, very nice. Money Talk is still up 175%. That's excellent. Because don't forget, we can't touch money talk. It's the same exact portfolio it was when I was last on the show. And in fact, that's an interesting one, because if we look back on the, where were we? There's a section for that. Money talk. Here we go. Dun, 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 dun. See, we added Lebu and we added SunPower, which I believe are reflected here. Lebu and SunPower, right? Not that one. That one. So it's from 216, about 2 months ago, and we were only at 140% on 216. So now we're at 175%. So we're up 35% since 216. That's pretty damn good. And what did we do? We got more aggressive on SunPower. Well, we did a few things. Boyd, we sold 5 June 75 calls on Boyd, and Boyd is now at 69. It's at 70, so we're glad we sold them. Where are they? Oh. I was like, they're not reflected here. They're reflected in the new portfolio, I hope. Yeah, there they are. See, 575 calls. Right. How can they be reflected there? That's where we decided to make the changes. So we did that with Boyd. Gold we didn't touch. Hewlett Packard we didn't touch. IBM we didn't touch. Intel, we rolled the 2024 45s down to the 40s. And that hasn't actually helped. I mean, they haven't gone anywhere, but they for a minute were starting to go higher, but they gave it up. SunPower. And see, SunPower, we bought back the short 35 calls, we bought back the short 25 calls, and we rolled the 25 calls to the 15 calls. Wow, got super aggressive. And that was good timing. So here's where we got super aggressive. And here's what happened since. They're up 50% since we got super aggressive. Now unfortunately, we can't cap them or do anything with them because, where is SunPower? So we still have the short puts. We bought back the short calls. We rolled those to the 15s. That's up $19,000 since we took that action. So that's nice. But we can't lock it in, unfortunately, so until I get on the show again, we won't be able to. And then probably, let's see, I was on, what was that, February 15th? So February, March, April, May. So probably middle of May, I'll be on the show again. And what else did we have? We had Viacom. Did I miss one? Oh, I feel like I missed one. I think I did. Oh no, there it is, WBA. And then Viacom we didn't change, which is now Paramount. And then we added Lebu, the biotech ETF. We added that as a new one, and they've been sort of languishing, but I'm glad we got it. And I think it was a good entry. And even though they're languishing, we're still, we're not up. I mean, we're up a tiny bit, so it doesn't really count. Oh, that's not them. Lebu. There's Lebu. I know, yeah, we are up. Okay. So we're up a little bit. No particular reason, just sort of fluctuation in the options. It's only up a buck. So, and that's also important. Sometimes, I mean, you don't have to go crazy with your hedges because sometimes you have to understand that your profit is your hedge. We're not supposed to make 35% in 2 months. That's not normal. We make 10% a month. We should be thrilled. That's 120% a year. That's crazy money, right? So if you make 40%, 35% in 2 months, if we drop 10 or 15%, that's not a big deal. It just means you made 10%, 20% in 2 months instead. So to some extent, the excess gains that you make are also your hedge. You can't just react every time as if you're losing. You can't take the maximum amount you have and say, that's my benchmark, I've got to keep that. Otherwise, you're going to end up over hedging every single time. You know, you got to keep it in perspective somewhat. And the hedges aren't meant to 100% stop you from losing money. They're just meant to mitigate the damage so that you can make the decision to hold on. So in other words, like right now, I'm not panicking out of the puts. Why? Because the short-term portfolio made $50,000, and we're down to what I say, $28,000 or something like that on the short puts. You know, and of course the other positions are down too. But the thing isn't, though, we're covering those losses. It's not killing us. If it starts to kill us, I'll get concerned, and we'll have to make some adjustments. I don't think we're not being adjusted enough. But on the whole, I believe that as of the last portfolio review, we had $3 million. I'm pretty sure that's the right number. It's pretty. Yeah, in fact, it wasn't 3 million, so I would have to make 3 Dr. Evil. So it was less than 3 million. So it was no more than 3 million. So I would have to put a third Dr. Evil. That's a good visual reminder, actually. We go crazy. We've never had 3 Dr. Evils before, because I always reset the portfolios. So we were under $3 million in the last review, and now we're is it 295 or 29? So now we're at 29, let's say. So we're down $100,000, but it's 3%. So that's fine. We're fine with that. And again, don't forget that the hedges don't fully kick in on every little move, because there are some of them, they're pretty much in 2024, 2023 now. So you're not going to get an immediate feedback on everything that goes down. If it goes down and stays down, then the premiums start washing out of the spreads of the hedges, and then we start making more money as they come closer to expiration. But that only affects us if the market goes down and stays down. But if it bounces back up, then we didn't need the hedges, and the longs take over and get the money back. You know, now in an ideal situation, we get a nice correction that overcorrects, we cash out our hedges, and then play for the bounce back, and we make our money back on the whole thing. That's how we basically make all our money in these portfolios. You know, when the market gives us a huge sale, we actually buy more stock instead of panicking out. But the reason we're able to do that is because of the hedges. The hedges are what give us the confidence to buy more, because I'm like, well, if it stays down, we're going to make another $500,000, you know. So if it doesn't stay down, we want to make sure we make the $500,000 a different way on the longs. And believe me, we're going to get a chance to practice this again very shortly. So, you know, it's going to be interesting. Now, the other thing is, I wasn't expecting this sell-off this week. You know, this is, I was expecting a fairly flat week, and we might come back later. The Fed's going to have their minute shortly, and that's what everybody's kind of freaking out about. Based on what the Fed people have been saying this week, everyone's coming back a bit more hawkish than what people were taking away from Powell's speech after the Fed meeting a couple of weeks ago. So after the Fed meeting, people took Powell as usual as being fairly dovish, but the commentary from the Fed speakers in the past week has been essentially more bearish than Powell. And so if the minutes come out as more bearish, and basically what that's telling everybody is don't listen to Powell, which you should know by now anyway. The guy who said I haven't seen inflation for the last 2 years. So if the minutes come back, if the minutes come back showing that clearly everybody on the Fed, including Powell, said we're going to be raising the crap out of rates, and Powell didn't say he's not doing that anyway. People just took little things he said as being more dovish, but the reality is he said we're going to raise rates 2% plus this year. Every single meeting. It's 8 meetings with a quarter-point hike. 8. I don't think they have more than 8 meetings. So basically 8 meetings with a quarter-point hike this year means every Fed meeting, quarter-point hike. But what we're hearing from the Fed speakers now is a couple of them, certainly a few of them, are pushing for half-point hikes. You know, they want to get this done early. And they know it's going to tank the market, and they don't care. And that's another important point that's coming out this week in the things they're saying. They know the market's going to tank. They know rates are going to push it down. The investors don't seem to understand that, but the Fed speakers do. They're like, well, yeah, it's going to hurt the market. Of course, it's going to hurt the market. When would a 2% rate hike not hurt the market in 1 year? And it's not a little 2% because the government and corporations have never been more in debt than they are now, but they're in debt at 0.25% plus prime is maybe 2%. So maybe they're in debt at 2% or less on the interest on their loans. So interest is an expense. So when you go to a corporate balance sheet, so when we go to a corporate balance sheet, this is not a balance sheet. Balance sheet. There you go. Or maybe cash flow. Sorry. Silly me. Oh, stop it. Yeah, it's going to be on the. It's going to tell you what your debt is, but it's not going to tell you your interest. Dividends paid, financing, cash balance. Oh, come on. Retirement of debt, that's not the same thing. Cash balance, finance, cash flow, cash from investing. Oh, come on, where is it? Is it over here? Operating expenses, income tax, net income, extraordinary items, common, EPS, diluted, income, dividends per share. What? Long-term investments, account payable, accrued expenses, short-term debt, long-term debt, total debt, minority interest, tax liabilities. Oh, come on. It's in there somewhere. No kidding. I don't know. Who's an accountant? Somebody tell me where this is. All right, I'll wait. Anyway, the point is, it's an expense. Somewhere in here, it should be an expense. Interest is an expense. So if you owe, as a company, $10 billion and you're paying 2%, then you're going to pay, all right, smarty pants, $200 million in, yes. Wait, if you owe 10 billion, 2% of 10 billion is 200 million, correct? So you would pay $200 million in interest, right? But if interest rates go up to 4%, you will now pay $400 million in interest. So that's a problem if your balance sheet, if your adjusted earnings after interest expenses and so on and so forth is only $1 billion, and you have $2 billion in debt, and you made $1 billion, but with $200 million in interest. Now you have $400 million in interest. You're only going to make $800 million, 20% less earnings. That's a significant amount. So you have to go through your companies and figure out how much debt do these guys really have and how much interest do they owe. And I'm sorry, I have no idea where it is. I don't know what the frick is going on here. I mean, you can see the debt, long-term debt, there's right there. Here, Disney, for example, $48 billion in debt. Total long-term debt, $48 billion. It would be nice to know what they're paying on that. I can't believe that's not there. But anyway, so Disney has $48 billion in debt. So if Disney has to pay $48 billion in debt, it's actually 48.5 billion in debt times 0.02 is almost $1 billion. So then you go back to, now this I know how to read. You go back to the freaking income statement. Well, let's say, where's the stock report? That's easier. So then I go back to the income statement. I say, wait a minute. They only make $10 billion. They only make $10 billion. If they're going to pay another $1 billion in interest payments next year, their debt's not going to magically go away. They're carrying a massive amount of debt. Now, the massive amount of debt doesn't hurt them that much. They're still making $8 billion, $10 billion a year. So they took the debt to grow the park. You know, they built their Star Wars hotel and things like that. So they take on debt to do things with it. That's fine. There's nothing wrong with debt per se, and they're servicing it. But now is a trap that all these companies have walked into, because they took this debt and now they've got to suddenly pay double the interest that they were paying. Of course, it's attractive to borrow $50 billion if you're only paying 2% interest. And frankly, even 4% interest isn't horrible. You can certainly make more than 4%. If you're a smart company, you can make more than 4% on your money. But the problem is, now they've eaten into their earnings in a significant fashion. And that's going to start being taken into account. This is a $250 billion company that will make $10 billion if they're lucky. So forward earnings are 25 times earnings, but it's not 25 times earnings anymore, because now it's going to be 9. So now it's 250 divided by 9, not divided by 10, and it's 27.7% earnings. 27.7 times earnings. I mean, you're getting too high. And this is even at the same time when I'm telling you that the whole S&P is too high and we shouldn't be accepting these kind of multiple returns anyway. So it would not be far-fetched for Disney to correct 20, 30% and get back to 20 times earnings. Their normal trading range is probably 15 to 20 times earnings. This has not been the kind of stock that would play for this. And if you look at their peers, they're nowhere near there. In fact, look at Paramount. I mean, you know, they're not. Disney's got cruise ships, which frankly shouldn't be getting a big premium right now. Disney's got the studios, the entertainment, they're heavy into film, shouldn't be getting a big premium right now. That's still not coming back at, you know, nowhere near the levels they used to be. They've got hotels, travel still isn't fully back this year. Why are they getting these premiums? And you say, sure, they're going to grow in the future. Everything will be hunky-dory. There'll be no more COVID. There'll be no more war in Russia. People will be flying and going and doing and whatever. It's like, well, I hope so. But does that still mean I should pay 30 times their forward earnings? It's a problem. We are way overbooked on a lot of these stocks. So you've got to look at your stock and you've got to look at the debt of your company and figure out net debt. So they're doing debt net of cash, blah, 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 book value. It's annoying. But anyway, so even if you can't calculate how much interest they're currently paying, you certainly can calculate how much 2% more is going to be. And in Disney's case, it's a freaking $1 billion. Because they got $50 billion debt. Who else has this kind of problem? AT&T. I mean, any telco is going to have this kind of problem. A lot of oil companies are going to have this problem. Well, here you got to go to the balance sheet. So you just want to find a place where it's going to tell you what the total debt is. $178 billion for AT&T. So 178, that really doesn't, the 695 doesn't really matter at that point, does it? 138, 695 times 0.02. 3.5, basically $3.6 billion additional interest that AT&T has to pay. And now we go back and say, well, how much do these guys make? They make $20 billion. That's 15% of their frickin' earnings. This is not being taken into account. And the more that you see the Fed firm up and the more people start to accept the fact that rates will be 2% higher at the end of the year, you've got to see these premiums coming down for these companies. They're not going to magically generate this money. They borrowed a lot of money to do stuff. AT&T, I mean, and again, there's a real reason for it. AT&T built 5G along with all their peers, and they did all kinds of stuff, and they'll make billions and billions in the future. And would I tell them not to do it? No, I wouldn't tell them not to do it. But the reality is now they're being treated in the market as if this isn't going to happen, but it is. And frankly, these companies haven't been disclosing in their forward earnings statements that this is going to happen. They have an excuse not to, because the Fed never definitively states their plans. Why don't they definitively state their plans? This is exactly why. Because if they definitively stated what they were going to do, the companies would have to put it in their reports, and that would be shocking to the markets. They want the markets to gradually ease into this, but this is why you hear the Fed people talking and saying, well, obviously the markets are going to go down, because obviously at some point they're going to have to recognize the fact that rates are doubling. And they may not stop there. That's the other thing, though. You don't know that they're going to be done. You know, I was talking this morning about how my dad in 1976, I forgot the year now. Was it the year I said? La da 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 da. I don't remember. I think it was around 76. I was in junior high school. 78. Oh, okay. How old was I in 78? I was 15. Oh, yep, that's the right year. Okay, so in 1978, my dad got an 8.8% mortgage. And we were lucky because that was the beginning of an uptrend that was crazy, that went to 15%. So it's the same thing as now, right? We're used to 2%, it goes to 4%. We're like, well, that's going to double the expense of the interest. Well, that would be the same thing as if the companies were currently paying 8% and it went to 16%. You'd still be in the same boat, right? But 8% to 10% was no big deal. 8% to, you know, so having been at 8% for many years, it wasn't shocking to go to 10, and it wasn't that shocking to go to 12. But when you're at 2%, you go to 4%, that's shocking. It's not the 2%. It's the doubling. You're paying X amount of interest now. You're going to pay 2X next year. If that interest amount is big, and it is huge, because companies borrowing at 2%, it's like being given free money. And they went crazy borrowing money. So in the aggregate, they've got a lot of money to pay back, and it's going to double the interest rate. And it could triple, because 4% still is very low when my dad was taking an 8.8% mortgage in 78. That's how you fight inflation. I don't think a 4% interest rate is going to fight inflation. Inflation is not going to go away because you have 4% interest. Inflation is going to, you know, I would say probably we're going to be at 6% before this is done easily. And that's triple where we are now. That's $2 billion taking off of Disney's earnings. And meanwhile, we're paying him 27 times forward earnings for this. This is crazy. So the thing is, though, then the question is with the portfolios, do we go to cash? Now, if you go to cash and there's 10% inflation, you're in trouble too, because you're not keeping up with inflation. Your cash is losing value. Now you can take the cash, put it in bonds, blah blah blah. You know, but again, nothing keeps up. It's very tricky. So you know, I think that's another thing. I think if we're going to go to cash, I think we have to start thinking about what we want to put our money into, and you need to hedge the inflation of your cash, and we do that with gold, and we do that with commodities and things like that. There are certainly bank stocks. Banks tend to do very well in inflationary environments because they're still borrowing at the very lowest possible rate, but then they get to lend at much higher rates. So in other words, the banks have X in reserve, right? So the banks have a certain amount of money in reserve. They can lend 10 times the money, and they haven't lent out all their reserves yet. So therefore, the banks, as the rates go up, they're more willing to lend because the risk-reward profile of their loans changes. They still have the same risk profile of lending certain people money for certain amounts and so on and so forth against certain assets, but now the reward is much higher. So therefore, they're getting a better return on their risk that they put out. So it's great for banks to be in a long-term inflationary environment if it's stable. If it's unstable, it's tricky. If it's stable and constantly going up, great for the banks. Totally great. So we can invest in banks. We can invest in, you invest in utility companies because eventually they get the permission to raise their rates. So you find the ones that are going down because people feel that they're no longer able to keep up with inflation. Then they get then they pass a thing letting them raise their rates, and all of a sudden, boom, they're back in the green. You know, obviously there's still things like auto companies and stuff that we can invest in, energy companies, you know, green energy. So, you know, it's not like there's nothing to invest in. You just kind of change the nature of your portfolios to be mainly cash and long-term growth things that pick up with inflation and so on and so forth. So it's a rejiggering that has to go on, but we gotta stay on top of that. That's how we're going to probably spend our summer. But it's going to be interesting, and we have 10 minutes until the Fed actually puts out their minutes, so we'll see what happens then. How are we looking? Let's see, things are picking up already. So, I mean, this was a harsh reaction to something nobody's seen yet. So we'll see what actually probably going to balance out a little bit, but I don't think we're going to get a big recovery. But that's what's going on at the moment. That's what we're seeing. It's people are getting very, very nervous. So let's see. Brendan, okay. Brendan says it's in the cash flow from financing activities on the cash flow, but I don't see it on Stockopedia for some reason. Oh, thank you. Okay, so I'm not crazy. Yeah, I expected to see it in the on the cash flow statement. It's not there. I don't understand that. Why is Para predicting such a drop off in net income in 22 and 23? Let's see. I honestly don't know, so we'll have to look it up. There, did they spin something out? Oh, I'm forgetting now. Paramount, Viacom, CBS, and they changed the name to Para. Did they spin anything out? They didn't spin anything out though, did they? Did they spin out a division? I don't remember anymore. It's like I don't remember what happened when they did that. If they spun out a division, that would explain it though, and then that money's coming in somewhere else. AT&T spinning out a division, I remember that for sure. But I don't think Paramount did. You know, there's reasons this kind of stuff happens. Sometimes they're selling assets. Obviously, if they have film assets, if they have a studio they sold, if they sold the rights to stuff, you know, you can make a profit without doing anything by just selling future projects and things you have the rights to. They could, I know they sold some studio space that probably generated money in 2021, which was, you know, I mean, smart, like get some money, have some cash flow. And probably they probably picked up some cash and now they're spending their cash, and that's going to, you know, show as a short-term loss for not R&D, but you know, whatever you call it, like asset developments. But it's worth looking into. So remind me, and we'll take a closer look and find exactly what they are doing. But meanwhile, they're at 24 billion. They're going to make, you know, 1.5 billion. I can accept that because it's what do you got? 20. 4 divided by 1.5 is 18, right? Okay, 16. So they're trading 16 times earnings, and we know that earnings can be better because they're in an investment cycle at the moment. Oh, and let me tell you something. I mean, they're spending a shitload of money on the Star Trek stuff. Totally worth it. Totally worth it. I mean, they're got some really movie quality shows that they're putting together, and they're going all in on the online space. I mean, they're shifting themselves to become an online network. So we shall see what happens. But yeah, now, oh, that's important too. How big of a hole is this debt going to punch into them? So their total debt $17 billion, and what's that? 350 million, right? 17,709 times 0.02, $350 million, not billion, $350 million. And but that's out of now. Oh, and by the way, that's another thing. It's possible that Paramount, you have to be careful about this, because it's possible that Paramount has taken this into account and projected it. Some people do and some people don't. So we don't know that they may have already put it in there. That's something you got to watch out for. If you have conservative accountants and they predict what the Fed's going to do and they push it into their projections well in advance, you're going to get some numbers, and that's why you company to company, you got to be very careful about what projections look like. You got to say how do they get to this number, and you got to do a deep dive into these things. Bottom line is though that if 350 comes out of this, it's going to be 25% of this number. But fortunately, we're starting at a PE of 16, so it goes to a PE of 20. Not a tragedy. And again, we feel that they can do much better. I'd say probably it's in there though, the way it looks, unless there's something else going on. What was I going to look at? Something I was going to say about it. I do not remember. All right. Anyway, oh, Fed, wait, Fed. Then we'll see what everybody else has to say about it. Wow, this is slow. I guess I got a restart warning on my computer already. Oh, 3 minutes till the Fed. What is this? No, that's a statement. No, that's not even the Fed. Oh, I guess probably because everybody's on it. Yeah, look at that, slower and slower. Too impatient. Seriously. Wow, that's just sad. Well, see, exactly what I'm telling you about things slowing down when the market crashes. Everybody's trying to do the same thing at the same time. That's interesting. That's a lot of interest because we don't usually have this problem loading the site. Yep, just back to the same shit. See what the immediate market reaction is. Oh, look at oil. Wow. Really didn't like that inventory report today. Holy crap. That's awful. 5%. Oh, I remember what I was going to look at. Yahoo. It's one nice thing they do have on Yahoo. PARA. They have an analyst estimate. That's the thing that I couldn't remember what I was going to do. And it was because I never do it. Yahoo. Analyst estimates. Earnings history, EPS trends. Okay, so EPS trends. So for the current year, look what happened. 90 days ago, 384, 374, and it dropped considerably 30 days ago. So between 60 and 30 days, considerable drop in the estimated earnings for this year and next year. So what? And now last year, no, that's not going to show you last year. Growth estimates. So that's what you want to look for. Is these EPS trends are kind of useful for that, because then you can see what happened at this point here between 30 days and 60 days. Both 2022 and 2023 were taken down considerably. So then we got to do a little bit of research and find out like what actually happened. But very clearly, holy shit. All right, we may never know what the Fed says. Apparently it wasn't so bad though, right? Nothing too terrible. How about Mr. Wall Street Journal? Where are you? Oh. How about the Times? You can't count on the Times they don't jump on things the way the Journal does. I mean, business stuff anyway. More sanctions, blah. Okay. They're just complaining about the Journal yesterday, but they are still the go-to for this sort of thing. So the thing is, the big papers, they've got the minutes before it even happens. They've already read them and looked at them and started writing the article. What? Losses before Harker expects rates to rise. Capital account. No, it's not there yet. Mm-hmm. No update or anything so far. Ooh, look at that though. Okay, so obviously not as bad as everybody feared. And let's go to the Twitterverse and see what they say. Elon Musk's Twitter. Looking promising. One or more 50 hikes may be warranted minutes. Officials plan to shrink the balance sheet by $95 billion a month. That's pretty aggressive. Actually, that's not true. It's not that aggressive because they've got a $9 billion balance sheet. It'll take them 10 years to drop it off. FOMC backs roll-off cap phase in of 3 months or modestly longer. Many Fed officials say one or more hikes may be warranted. Many Fed officials, I'm always worried about that. This is probably that same page that won't load for us. Yep. So we're still waiting over here for it to load. How annoying. Have you stopped loading? Look, haha. Minutes. At least that works. Oh yeah, but I forgot how tedious the minutes are. All right. How bad is this? Let me see. No, 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 no. Let's stick with Twitter. Developments. The manager turn first review. All right. When you're reading these, you got to first of all put yourself in the mindset. This is what they knew on March 16th. So the war had just started on March 16th. I mean, we're a month into it now, right? So it must have been like the early March that it started. Global blah, 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 price of dollar-denominated Russian bonds, local trading Russian equities, exports, blah, 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 development of Ukraine. So very, very worried about the Ukraine here. In the U.S., incoming economic data, Federal Reserve communications led investors to expect a more rapid removal of policy accommodation than they had previously expected. So they are getting more hawkish. Market participants almost universally expect a 25-point increase in the rates at the current meeting. Moreover, future prices implied that the federal funds rate would increase around 170 basis points through the year end, after already having hiked 25, and about 70 more than had been priced in at the time of the January meeting. So they pretty considerable increase. Similarly, the median projection of the target range of federal funds of 150 basis points this year, projected path, and a 100, another 100 by the first half. So in other words, during 2023, another 100. So 150 more this year. So that's 1.7. That's from 0.25 to 1.75% this year. That's why the markets are reacting positively. They're putting a definitive number on it that's not as bad as they feared. It's not 2%, 1.75%. That's significant. And they're saying another and another 100 next year. So the pace will slow next year, but you're still going to be up to another. You're going to go from 0 to 2. And this is the Fed funds rate. That's not the rate that the like I said, it doesn't matter. It matters that the corporations pay 2% more. So they'll pay 2% more interest, but then another 1% more the next year. So that $1 billion of interest becomes $1.5 billion for Disney that they have to pay every year. And that's every year until they pay down their $50 billion in debt. And of course, it's harder to pay $50 billion in debt down when you owe $1.5 billion a year in interest. So there it is right there. That's why you're having a generally positive reaction. It's not as bad as people were fearing. People thought there were going to be a two number on there for interest by the end of the year. And also, they're sort of clarifying the concept that if they raise it 0.5 point, it's still within that total of 1.5 additional points. So the argument is basically that the Fed managers want to get it out of the way early and have room to adjust, as opposed to this incremental crap, which is just a sort of a slow drip. The desk manager provided an update. Then they talk about. And the balance sheet, the way they're reducing the balance sheet is so slow, it's pointless. They have a $9 trillion balance sheet, and they're going to take away $90 billion a month from the balance sheet. So it'll take an entire year to drop 10% off the balance sheet. Are you even serious about reducing your debt? So that's a huge plus for the market. Information available at the time of the 15th statement suggested real GDP is increasing at a pace that's slower than the gains in the fourth quarter of 2021. Labor market conditions improved further in January, February. Consumer price inflation. By the way, when I was looking at the labor numbers over the weekend, because this is what I do on the weekend, but what I was noticing is that, because something was bothering me about the numbers that we saw last week. And what it is because we were talking about, like, oh, if you add this many jobs, it should be this much money. But it's not. You're not seeing that much money coming into the economy. Why is that? Most of the jobs being added are the very low end of the spectrum. There's not a lot of high wage jobs being added. So the demand for jobs, and what everyone is complaining about, is they can't find people at Wendy's and they can't find people to sweep the floors at Walmart and things like that. Why? Because there are a nice amount of better paying jobs. So people who want better paying jobs are filling them. And so in other words, when there are no jobs, right, when there's not many jobs available, then people who are supposed to be an office manager in a building in New York somewhere are being a shift manager at McDonald's instead. And obviously, as soon as the office manager position opens up again, they're boom out of McDonald's, and there's a hole to be filled. Now McDonald's promotes a floor sweeper; he becomes the office manager, the shift manager, and now you need a floor sweeper. All right, so that's what goes on. This bumping goes on. But the thing is that these jobs that are open and the jobs that are being filled and seem so nice are really low wage jobs that we're not really filling, or we're not creating higher wage jobs. And that's obvious, right? Think about your own office. Think about if you work at home now and whatever, think about like how many less people and what's going on. It's like there's not a lot of huge expansion going on in the higher paid in the white collar world. So yeah, it's nice that we're creating all these jobs, but they're shit jobs. So total non-farm payroll employment grew strongly. Unemployed rate edged down. Unemployment African Americans declined. However, both rates remain noticeably higher. Blah blah blah. Labor force rate increased, as did employment population rate of private sector jobs. I wonder if they talk about it. The quits are also remained. Average hourly earnings rose 5.1% over 12 months in February, about the same as its year earlier pace, with widespread increases across all industries. So average hourly earnings rose 5.1%, but that's not what you expect when you have all these people getting jobs. That doesn't even keep up with inflation. There's nothing to be proud of there. Tight labor market, supposed good job mobility, people high quit rates, but people are only making 5.1% more than they made 12 months ago in the middle of a pandemic. Consumer prices, right there. Consumer prices are up 6.1%. You're getting a 5.1% raise. Congratulations, you're down 1%. Blah blah blah. PCE. Blah blah blah. Blah blah blah. CPI 7.9%, or you're down 2.8%. Take your pick. It's not good. Bottom line, not good. Real PCE appeared to be rising at a faster pace. Blah, blah, blah. International trade, incoming data suggests rapid spread of Omicron had tempered foreign recovery around the turn of the year. Purchasing managers indexes were consistent with Omicron. Blah, blah, blah. And Russia did some bad stuff. Blah, blah, blah. Financial markets are volatile. Investors interpreted incoming economic data. Spreads of investment in speculative grade bonds, foreign asset purchases, liquidity became strained. Some financial markets during the intervening period. Hyper investors reported the strained liquidity at times amplified the volatility of prices. Short-term funding markets are mostly stable. Domestic credit markets, credit remained broadly available for households. Credit is accommodative. Credit card balances increased significantly in the fourth quarter. That's not good either. But that's because, and why does that happen? Because you're making less money. You get a 5% raise and 10% inflation. That's why your credit card balance goes up. And by the way, this is another fun thing I was reading about this weekend. I was getting a bigger picture. It's a lagging thing. You know, you got to think about it. It's a lagging thing. What do? You go to the grocery store, and things are more expensive, right? You go to the mechanic and get your car fixed. Things are more expensive. You go to get gas. It's more expensive. You take your trip. It costs more than you thought it would. The reason consumers are not spending less is because they haven't really had the time to adjust their behavior. You don't do anything differently until you start getting hammered with these bills. But it's too late by then. Your credit card spending has already shot up, but you don't you don't really, like at the grocery store, send things back because you go, oh my God, what? You know, it's like, what happened? Macaroni and cheese is $2 a box now? You know, you don't like put it back on the shelf. You're like, oh, it's 50 cents more. I'll pay 50 cents more. But it adds up. And then the next time you go shopping, you go, oh, I'm not buying that anymore. I'm not buying that anymore. That's when you get pushback on prices. But it takes a while. And the news cycle is so messed up these days, and that's a problem too, that everybody rushes to make these half-assed judgments based on a data report that can't possibly have the big picture. But it's because we have a 10-second news cycle now, and a month of data is all you have time to look at before you have to formulate an opinion and write an article these days. You know I drive everyone crazy, but I'm like, well, let's take a look at let's see a couple of earnings reports before we decide what we're going to do with them. It's like, that's 6 months. But that's what you have to do. I mean, you have to give things time to percolate. You can't just make snap decisions based on a single event. And I know everybody wants that. Everybody wants to get immediate this and immediate that, but that's just not the way. You're not going to get a good answer. You get an answer, but it won't be the right answer. Staff economic outlook, near-term projections, blah, blah, blah. March FOMC was weaker than January, reflecting Ukraine, less supportive, financial condition less supportive than previously assumed. For 2022 as a whole, real GDP growth stepped down markedly from 2021 before picking up slightly in 2023. But 2023 is now when everybody's projecting a recession. Real GDP growth we expected to slow further in 2024 to a pace that was in line with potential growth. However, expected well above potential for the projected period. The staff's near-term projection for PCE prices, blah, 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 participants view current conditions in conjunction, over the thing, longer run projections, participant assessment rates, summary of economic was released to the public. And we went over that when it happened, the summary of economic projections. In their discussion, they noted indicators, economic activity continued to strengthen, job gains have been strong, blah, 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 2% blah, blah, blah bullshit. With regards to the economic outlook, they noted that real GDP growth had slowed. Okay, so nothing exciting. Commenting demand for labor substantially exceed available supply across the economy, and the business contacts continued to report difficulties in hiring and retaining workers. Participants observed, and that's a break on the economy. When you can't hire and get workers, you can't grow. You're limiting growth. A couple of participants highlighted the annual benchmark revision to establishment. You know what would solve that problem? Allow 2 million Ukrainians to come live here. These are perfectly well-educated, nice people, and a lot of them speak English. So have them come over. Payroll employment below the pre-pandemic levels, consistent with tight labor market, wage gains that far, blah, blah, blah. Participants remarked that recent inflation significantly exceeds the committee's longer run goal, blah, 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 blah. Developments surrounding Russia, blah, blah, blah. Participants agreed uncertainty regarding the path of inflation was elevated. Several risks, including supply bottlenecks, rising energy commodity prices, Russian invasion, recent COVID lockdowns in China, which is still going on. Uncertainty about real activity as elevated. Oh, uncertainty about real activity. Well, that's interesting. I mentioned that too. Various putting the downside risks to the outlook, including risks associated with Russian invasion, tightening global financial predictions, and a prolonged rise in energy prices. All these things are happening. Everything they're worried about is actually happening. In their consideration, the appropriate stance on monetary policies, including the U.S. economy is strong, blah, blah, blah. Many participants noted inflation well above the objective, inflationary risk to the upside. Okay, they would have preferred, they would have preferred a 50-point increase in the target for the fund rate at this meeting. Wait a minute. Many participants noted, so that means more, you would assume if there's 13 Fed people, if you say many, it's very doubtful that it's 4 or 5. I would have to say it would have to be at least 6 or 7. It has to be, if you're going to say many in 13, I would think it's going to be 6 or 7 of them. It doesn't say most, it says many. So I'm going to go with 6 or 7. They would have preferred 50 basis points in the target range. Now, what's going to happen is they raised it 25 basis points. If the next inflation reports we get, and nothing has indicated any slowdown of inflation, but if the next couple of inflation reports we get do not show any slowing, they're all going to have to push to get a half-point increase at the next meeting, because they're going to say, well, that didn't do anything. 0.25 was useless. Because of the Ukraine, they held it down to 0.25. One or more, and again, many participants noted that one or more 50-point increases in the range could be appropriate at future meetings, particularly if inflation pressures remain. I just said that. A number of participants noted that the committee's previous communications had contributed to tightening conditions as evident by the blah, blah, blah. Sometimes they already talked up rates as much as they could. Now they have to actually show that they're serious about it. They all participants, strong commitment to take the measures necessary to restore price stability. They are all very concerned about inflation. They have to do this. There seems to be no dissent on this thing. Members, blah, 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 affected, blah, 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 and then that's the statement. And Bullard voted against, and Bullard voted against, we already know, because he wanted a 50-point rate increase and he wouldn't go along with it. He preferred the thing to be, it says right there, he preferred to go 0.5 to half to 0.75%. He wanted 3/4. Good luck with that in light of elevated pressure. So in other words, that's where we're at. All right, so good. There's the nice summary of the meeting and what's going on. And the markets are, and they went back down. I'm sorry, but that was mild compared to what it could have been. But the bottom line goes back to what we were just talking about before. You're looking at a 2% rate increase. It is significant because 8% to 10% is a 25% increase in the amount of money that the people, you already have earnings, you already have the numbers, you already have an amount of interest you're paying, and therefore the 25% increase in the interest you're paying already isn't going to significantly impact your balance sheet. But 2% above 2% is a 100% increase. It means that whatever you were paying in interest is now double. That's huge. It is not the same thing at all. And believe me, if it was 8 and 10%, Disney wouldn't have a $54 billion debt. You can't, who can afford that? That'd be $5 billion a year in interest. Okay, the reason these guys have these massive debts is because the rates were this. Now, so what's that going to mean? Companies going forward are either going to have to accept much less earnings, which they don't like to accept, or they're going to have to start paying down their debt. And if they're starting to pay down their debt, that means their cash flow goes to debt, and therefore the company probably will be fairly stagnant in their growth for the next few years until they pay down a significant portion of the debt. Either way, you shouldn't be paying 25, 30 times earnings for stocks. It's idiotic. And you've got to go through your portfolios and you've got to look at who's got a lot of debt, and you have to start thinking maybe these guys are not a good keeper. Okay, you've got to start looking at our stocks. We have to start thinking about that. They are not going to stop raising rates, even if you scream bloody murder. All right, so that's where we are. That's where we are this week, and that's the takeaway from the Fed minutes and all that. So basically, the market has decided it's pretty much as scary as they thought. It isn't really that bad, but what are you going to do? That's where we are. And Bernie says, isn't the balance sheet runoff the big deal? Not at that rate, though. You got a $9 trillion balance sheet, and they're taking off 10% of it in a year. I know they've never taken off $100 billion in a month, but in other words, what they've got is they have a lot of short-term paper. How in here? Well, here's the problem with that, though. Even at $100 billion a month, it's still the actual number. He's making a good point. The actual number, $100 billion a month, is a huge number. So what has been happening for the last 10 years, basically, the Fed has been the #1 buyer of US notes. So we sell the Treasury notes and the Fed buys them at the ridiculously stupid prices, right? The Fed can't, they don't, when they want to reduce their balance sheet. So now they have $9 billion and maybe $6 billion of it is Treasury notes, right? They're mostly shorter term. They're all going to run out in like 3-5 years at the most. Probably a lot of 1 year, 2 years also. But so the Fed is the one at the auction who takes these notes. Now, if they try to cash them in early, it's a loss, right? Because the bond market went down and all the bonds are worth less than they were. So the Fed, if they're not going to cash them early. If you wait until they expire, you're cashing them out at face value. You're getting your money back, even though it's deflated money. You're getting the money back, and you've collected all the interest, so you don't show a loss. And that's the key. The Fed does not want to show a loss on any of this paper. So their notes are expiring at this rate at $90 billion. But the big problem is, the US government isn't borrowing less money. We're still borrowing $350 billion a month. And if the Fed's not going to be buying $100 billion a month, who's going to step in and take their place? That's the trick. Before, the Fed was rolling over and buying all the new stuff. So in other words, their old $90 billion would expire. They would buy $90 billion plus probably another $90 billion on top of that. So they'd be buying 2/3 of what the government is selling. So now the Fed isn't doing that. They're going to wind down their sheet. That means they're going to let the $90 billion expire. Somebody else has to buy the $350 billion the Fed is selling. If nobody's going to do that, what's going to happen? Then the government has to offer a higher interest rate. That's what it is. It's an auction. The Fed has to offer a higher interest rate on the notes to get somebody to buy them. And if that starts happening and gets out of control, then it's all going to hit the fan. Because then you're Greece. That's what happened to Greece. Greece said, nope, nobody wants to buy our notes. So we have to offer 6%, 7%, 8%, 9%, 10%, 20%, goes up to 22, 24% before people finally say, oh, I'll take a chance. I'll take 20%. We can't do that with a $20 trillion debt. Or 30 trillion, or whatever the hell the number is these days. Yeah, it's like 32 trillion, right? We can't do that. But it's all fake. In other words, our rates are fake. They've been fake because the Fed is buying all of our notes. So our interest rate isn't real. And that's a whole other crisis that nobody's even thinking about, is what happens if our rates start normalizing and they start becoming a true reflection of demand. And that we're going to find out the hard way if the Fed's going to start winding down their purchases. All right, so that'll be the next crisis we look at. So we'll move on from that. Anyway. All right, so that was fun. But yeah, Bern's right, because the thing about the problem there is that just the sheer number of it, the huge volume of notes that we're talking about makes it difficult no matter what they do. So it's not hard for the Fed to get rid of the $90 billion a month because they're not selling $90 billion a month. They're just basically, it expires, the government pays back the note, right? You lent the government the money for a certain period of time. The government will now pay you back the face value of the note. The note closes and you're done. End of situation. So the government retires the debt. But the government now says, well, I still need money next month, so they have to go borrow $350 billion. But from who? That's where the problem is. The Fed is the buyer of effectively 60% of the government's debt. How do you replace that? That's not the Fed's problem. Technically, that's the government's problem, but the government's problem is everybody's problem. All right, so that's the next thing you gotta, if you need something to stress about, that's the thing to stress about now. All right, thanks everybody for coming, and we'll do it again next week. Appreciate it.